The 60-40 portfolio, a mix of 60% stocks and 40% bonds, has been a staple of investment strategy for decades. Designed to provide a balance of growth and stability, this allocation was once seen as the golden ratio of portfolio design. But today, the 60-40 portfolio is dead. Here's why. For the first time in decades, we're at the beginning of a secular bear market in US Treasuries. This isn't a temporary blip, it's a structural shift that could last for years, even decades. Secular bear markets in Treasuries, periods marked by prolonged drops in bond prices and rising yields, aren't uncommon. From 1946 to 1981, for instance, bonds suffered one of their longest bear markets as inflation surged and interest rates climbed. Investors lost decades of gains in what was once considered a safe haven asset. And today, we're facing similar pressures. In a secular bear market, bonds no longer hold up their end of the deal. Bonds in a 60-40 portfolio are supposed to provide income, stability, and diversification from stocks. But in an environment of rising rates, bonds lose value, eroding the core stability investors rely on. But that's not the only problem. The US credit rating is under pressure. Credit rating agencies have already downgraded the US in response to escalating debt levels and frequent political gridlock over the debt ceiling. With Congress repeatedly approaching the brink of default, trust in US government debt is eroding. While an outright default on US Treasuries remains unlikely, these debt ceiling standoffs and escalating political infighting weaken confidence in US debt, driving up borrowing costs and straining the Treasury market. Global central banks are taking notice, too. There's a growing trend of central banks around the world diversifying away from US Treasuries and the dollar. Major economies, including China and Russia, have already begun reducing their holdings of US Treasuries in favor of alternative currencies and assets. As central banks reduce their dependence on the dollar, global demand for treasuries weakens, which could further increase yields and drive down bond prices, putting even more strain on the 40% bond allocation in a traditional portfolio. Then there's the issue of government spending. Federal spending has reached unfathomable levels, with the national debt ballooning to unprecedented heights. As government spending soars, debt issuance follows, flooding the market with treasuries. More supply with less demand results in even higher yields and lower prices, and it places immense pressure on the treasury market, undermining its traditional role as a safe store of value in a balanced portfolio. Political strife within the US only adds fuel to the fire. The constant cycle of budget battles, debt ceiling showdowns, and partisan gridlock creates instability in the treasury market. Investors are growing wary of the repeated brinksmanship that threatens government defaults or shutdowns. Each debt ceiling negotiation drags down confidence in the market stability, which in turn increases volatility and risk in the bond portion of the 60-40 portfolio. So, if the 60-40 portfolio is dead, what should investors do? History provides some answers. Let's look at the most recent example. During past bear markets in treasuries, real assets like commodities and real estate offered solid returns, as they tend to appreciate with inflation and provide tangible value. In the 1970s, for example, gold prices soared as inflation eroded the value of the dollar. Real estate also thrived, as property values and rents increased, offering protection against inflation and currency devaluation. High-quality dividend stocks offer another alternative, providing income and potential growth to help portfolios keep pace with rising costs. The 60-40 portfolio served its purpose in a time of stable growth and low inflation. But today, that era is over. Bonds can no longer be counted on to provide reliable stability. The modern investor needs a new strategy, one that leverages real assets, focuses on dividend-paying stocks, and avoids over-reliance on bonds in a high-rate environment.